Jeff, last August, we had a little bit of fun and we did a mini contest between the two of us. We called it the Magnificent Earth 7, and we each came up with a stock that we thought maybe could do better than, or be at least an alternative to one of the seven Magnificent Seven stocks. And we've already made one video taking a look at holding ourselves accountable, looking at how the stocks that we picked have done versus the first one, which was Apple. We're moving on today, and we're going to talk about two stocks that are more magnificent than Amazon, at least in our heads in this little tiny contest.
That's right. And it was a fun thing to do. And the catch was the company we came up with had to have some connection to the Magnificent Seven that we were replacing it with. So there had to be a connection. It couldn't just be a random stock. And I'm excited to talk about these two.
I'm Jason Hall. This is Investing Unscripted. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, you should go to our special link. It's fool.com/unscripted. Go to that link. The Motley Fool is going to give you its 10 best stocks to buy right now. Give it a look. Check it out. Okay, I'm going to share one thing. I didn't share this in the prior video, and I should have. If you go to the YouTube video and look in the description, we'll put the link. You can go to this Google Sheet. You see on the left, this is the Magnificent Seven, the actual Magnificent Seven from August 22nd when we did this competition, to the seven that I picked, my Magnificent Earth 7 and Jeff's Magnificent Earth 7 right there. So check out that link if you want more details. But today, again, we went with Amazon and the two alternatives that we picked. Jeff, you went with DigitalOcean, of course, is a cloud services provider mostly aimed at small and medium-sized businesses. And you don't like the one that I picked, Simon Property Group, which is a REIT. They own malls. It's very much a retail play, which Amazon, your thesis last year for Amazon, Jeff, was that its retail business would bounce back. My thesis was that Simon's retail real estate would bounce back. Here's the performance of those three stocks since August 22nd, 2023.
Yes, you are doing much better than I am in this little fun contest, and actually are beating the actual member of the Mag 7. And I didn't have a problem with your pick necessarily. It's just I felt it wasn't quite as connected to the original company as it could have been, but that's water under the bridge. We will move on. So you mentioned I picked DigitalOcean, and yes, they do basically what AWS does, but they cater to small and medium-sized businesses. They are more affordable. They have more transparency. It's a self-serve kind of model. There's a lot of support, and their whole business model is just basically, if you're a small business, if you're a 1 or 2 person shop, or even a 10 or 20 person business, you don't have an IT tech staff that can figure out all the cloud infrastructure things you need to run a modern business. And that's what they're there to do. For a while, they were doing really well, strong growth numbers. They were unprofitable for their first couple years as a public company, but they were generating positive cash flow. Lately, the story's been a little bit different. I want to talk through just a couple slides from their last investor presentation. Just to start off, as you can see, revenue growth has slowed to a not bad amount, but it has definitely slowed over where it was. But on the flip side, their adjusted EBITDA number has been ticking back up. All three of these slides are a tale of two companies, and it demonstrates, in my mind, where DigitalOcean is right now, which is kind of in between where it was and where it wants to get to. The next slide here, this is one that I'm particularly interested in as a shareholder in this company. Adjusted free cash flow. So not only is it going up on a dollar basis, but as a percentage of revenue, you can see that it's heading in the right direction. And I'm really happy to see that they are actually reducing their share count, as many tech companies do. DigitalOcean has a lot of stock-based compensation, but they've been buying back shares to try to counteract that. And they've done that to some effect over the last couple of years. This is where, again, mixed results. The net dollar retention rate has been slipping. It's down below 100% right now. So what that means is its customers are spending less this year than they were last year. And prior to that, they were spending more than they were in the previous year. But despite all this slowing growth all over, they're still increasing their average revenue per user pretty decently. So it's interesting that they're strong in some areas. They're showing weakness in some others. They had news at the end of last year where their CEO stepped down, and it took them a couple months to replace him. So I'm not as bullish on the company now as I was when I picked it for this little competition back in August, but I'm holding my shares. I still think they have some potential. They're holding their own against some pretty big competition, right? You figure they're competing against AWS, they're competing against Google Cloud, they're competing against Microsoft Azure. And the fact that they're even doing this well in that competitive environment tells me that they have something going on. It just remains to be seen if they can reaccelerate some of that top line growth and remain heading in the right direction with profitability over the next couple of years.
Before we talk about the case for Simon Property Group, I think some context is important. Number one, thinking about your timing and your stock is doing the worst of the three. It's still up almost 22%, which is that's pretty good from August. There's a lot of luck and timing. And as you said, the CEO change, the stock sold off a ton when that happened. And then, of course, we've seen a bull run for a lot of tech stocks since late August, early November. It's important to remember that a lot of this is just noise and timing, right? The performance of these stocks over the short term.
Absolutely. Although that dip and some of the sluggish share returns do correlate with some weakening in some of the areas of the business. So it's both of those
Yep.
things, and that's why I'm feeling like in between about the company right now.
Yeah, it makes sense that they mentioned the net retention rate, and then talking about average revenue per user. So it says there's more user churn, but the users that are sticking are spending more, right? So that's an interesting number you're talking about. So let's talk about the case for Simon. So I certainly part of my thesis for Simon over the long term was certainly stock price appreciation. Again, this is a real estate investment trust. It owns malls. The narrative around malls is that, like lots of physical retail, it's a declining industry and it's steadily dying, and that Amazon and others e-commerce is going to continue eating away from that business. And while it's true that e-commerce does steadily become a larger and larger portion of total retail and total commerce in North America, it's not completely true that the malls are dying. A lot of regional malls are, but Simon is one of the largest owners, either the number one or number two owner of Class A malls in the US. These are the malls that are in the areas where there's the right demographics of spenders. They've seen traffic steadily grow. Sales per square foot has continued to increase over time as the more and more we move away from the pandemic. And they have the right mix of businesses, increasingly experiential, things that e-commerce can't readily replace, where people want to go and do things together and not just good places to go and buy things. We've seen physical retail broadly, and lots of brands have pivoted to an omni-channel strategy that includes tying e-commerce to their physical locations for things like order online, pick up in store. Those are all trends that have been generally pretty positive for Simon Property Group. So what we've seen, sure, the bull market that's driven most stocks up broadly, but also a little bit of a recognition that Simon is a high quality business, has great tenants. Those tenants are very strong, and that keeps them paying for those rents and staying loyal to Simon. As a result, Simon's stock price has come up a lot faster, frankly, Jeff, than I was expecting. I will say you've talked a little bit about your concerns with DigitalOcean, whether or not you think about buying right now. It seems like it's more of a kind of wait and see. I do think as much as Simon Property Group stock has gone up, I think it's still a buy. It's still a reasonable valuation. The dividend yield is very high. The dividend is very stable. Their ability to grow the dividend, I think, over the long term is in a pretty good position. They should be able to grow the dividend over the long term faster than inflation. So if you're looking for income, you want to be able to factor in that dividend yield as part of your total returns, I think Simon Property Group is a buy. I'm going to ask you a last question. We haven't really talked about Amazon. Your thesis for Amazon over the past year from the lows at the beginning of 2023 was that its AWS business would continue to generate great operating results, but its e-commerce business would start to improve.
At the end of 2022, heading into 2023, there were several quarters in a row where on the e-commerce side of the business, both in North America segment and the international segment, they had negative operating income as they were trying to size from the massive expansion of their distribution footprint that they had to go through to meet the demand during the pandemic. And then on the flip side of that, obviously, they had to figure out how to get their expenses in line. And I just couldn't believe that the place I go first for everything I buy wouldn't eventually turn positive on operating income. And that was basically my thesis at the time. And it was super cheap because people were down on the business. And yeah, they've turned it around since. And all the things we were talking about prior to those negative operating income quarters have returned. And we don't talk a lot about some of the other things they have going on. They have a decent sized advertising business now, just people placing ads on the e-commerce website.
A decent size and growing.
That's turning into a nice revenue driver too. So yeah, they've turned it around. They're back to being the dominant force that they always have been, but there was just that little bit of market sentiment around them that gave us a good buying price about a year ago.
All right, let's take another look in 6 months and see how these are doing.
Let's do it.